All right, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And today's video here is my next installment of my live option trading series. So first, I'm going to show you the new trades I put on this week, and then we'll go over the current positions I have on in my portfolio. Now, as always, before we get started here, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so with that being said, I'm going to go ahead and play a clip from earlier this week where I put on a new trade in EWZ. So this was my only new trade this week. It was a rather slow week, but hopefully you'll find my analysis and my thought process around my EWZ strangle here to be interesting and also helpful. All right, today is Tuesday, July 6th, and what I'm looking at here is EWZ. This is a Brazil ETF that tracks the Brazil markets. And as you can see here, I've already gone ahead and drawn a few trend lines. So as you can see here, over the past a little bit more than 1 full year, this ETF has been range bound, but with an upward drifting bias. And recently, EWZ has reached the peak or the top of this range. So my assumption here in the short term, over the next few weeks and perhaps the next month or so, is that EWZ will continue to move down, just like it has many times in the past, all the way down to this support level, the supporting trend line at around 33, 34 bucks per share. And I do also want to point out, if I zoom out a little bit here, right now this is a daily chart showing 5 full years. This ETF clearly has the characteristic of moving up or down in a very choppy, range-bound kind of action, right? I could draw these same 2 trend lines over here. The supporting trend line would be down here, connecting all these troughs, if you will. And then the resistance trend line would be up here, connecting all the peaks. And same exact thing over here. So whatever it is about this ETF, it definitely has the characteristic of moving in this kind of fashion. So that's why, zooming back in here, that's why I think in the short term that this ETF is going to sell off all the way down to perhaps around 33 to 34 bucks per share. And of course, the other major thing I look for before selling options is I want to see a spike in implied volatility. So EWZ is down pretty hard today. I'll zoom in a bit more. There we go. You can see it here. It's down by about 3.3%, which is a pretty big down move for a large ETF like this. And that's why you're also seeing a pretty nice spike in implied volatility. So the IV rank is at 48%. That's very good. And the IV percentile is at 56%. Not bad. Now, overall, the implied volatility at 43% is just okay. ETFs will typically never be as volatile as individual stocks, but still, for an ETF having an IV of 43%, that's actually pretty good. So let's come to the trade tab now, and we'll take a look at the option chain on EWZ. I'm in the August expiration cycle. These options expire in 45 days. And so I'm thinking of selling the 41 strike call option along with the 36 strike put option. So this is a moderately bearish skewed strangle, right? Because the delta on my call option is larger than the delta on my put option here. So of course, I want to construct this strangle to reflect my bearish assumption on this ETF in the short term. Now you'll notice my strike for my put option is at 36, when I said I do think this stock or this ETF could come all the way down to perhaps 34. Now EWZ may definitely come down to this point, but perhaps not by the August expiration date. As you can see back here, from the previous peak and then the sell-off, this took 2 full months to happen. Moreover, my break-even points, if I were to sell the strangle, let's go ahead and set it up so you can see the credit I would receive on it. Go to strangle, so sell 1 contract, 41 strike call option, and then the 36 strike put option, which is right here actually. So I would receive 160 bucks in credit for each strangle I sold here, which means my break-even points are pushed a full $1.60 beyond both of my strikes. So on the downside here, my break-even point is not at 36 bucks per share. It's actually at $34.40, which on the charts is right around here, very close to that supporting trend line. So even if EWZ sells off faster than I think, and it goes all the way down here before the August expiration date, or by the August expiration date, I will at least break even or have a very, very small loss on the trade. And then similar to the upside, my call option is at the 41 strike, which is right here, a bit below the 2 peaks. So if I'm totally wrong on this trade and EWZ turns around and goes higher, well, my break-even points on the upside are all the way at $42.60, which is actually above these two peaks. So really my range of profitability is all the way at $42.60 down to $34.40, which pretty much covers the entire width of this range here. And that's what I'm looking for. So finally, let's go back to the trade tab and we'll make this order official. I'm actually going to sell 2 tranches of this strangle, so 2 call options and 2 put options. And that brings my total credit to $320. So we'll go to confirm and send and take a look at the buying power effect on this trade here. It's going to require $1,145 of my capital to be locked up and set aside. That's fine. That's under 5% of my total account value, which is where I like to be. And so finally, we'll go to send. And so I'm not filled yet. Let's come back to the monitor tab and take a look at what's going on here. So EWZ should be right there. There's my order. And there we go. You can see my limit price and the mark price are exactly the same, but still, sometimes you might have to come down 1 or 2 pennies to get filled immediately. So I'll come down to maybe 158 and see what happens here. So 158, confirm and send, and there we go. Just got filled at 158. Not bad. And then you know the drill from here. I'm going to set up my automatic closing order to take my profits if I am indeed correct on this trade. So now we're going to set up a buying order to purchase this strangle back. So we're going to buy back the 41 strike call option, buy back the 36 strike put option right there. And we're going to do so at half of the maximum profits. So half of 158 is 79. And we're going to buy back both strangles. So it's going to be 2 contracts we're going to buy back each. And we'll make this a GTC closing order, confirm and send, there we go. And actually one more thing I'm going to do here is I'm going to set up some alerts that will notify me when EWZ or if EWZ ever breaches my call strike or my put strike. Because in the event that that happens, I then need to go into my platform here and set up my orders to hedge this position to either buy or short shares of this ETF if EWZ continues to breach my strikes even further. So I can just right click on anywhere in the option chain and go to create alert. And then I'll change the alert type to stock. And I want to be notified if EWZ ever hits a price of $41 per share. That's my call strike. So I'll hit create. And then I'll do it one more time for the put side. So I'll go back to stock again. And my put strike is at 36. So let me know if EWZ ever gets down to that price point. There we go. Hit create. And now we're good. And you can actually see these alerts on your chart visually, right? These brown lines with these tags will show you the actual price points on your chart where your alerts will get triggered. So here is $41 per share, and then down here is $36 per share. And like I said, if either my strikes get breached and also EWZ continues to move further beyond my strikes, let's say it goes above $41 per share to 42, 43, and so on, then eventually I will start buying shares of this ETF to hedge my naked call options. And then conversely on the downside, if EWZ goes to 36, then to 35, 34, and so on, then I will begin to short shares of this ETF to hedge my naked put options. So that's my general approach as of right now. I sell options when implied volatility is high, and they're typically naked options. And then if I'm wrong on the trade, wrong directionally, I will wait until I'm really wrong, and then at that point, I will start to hedge the position with either long or short shares. And the reason why I wait until I'm pretty darn wrong is because most of the time, and I've done my own research on this, and I'll post a card above linking to the video that will show you just how often strangles actually turn a profit. Most of the time, even when your strikes get breached, and also by a pretty significant amount, by the expiration date, the stock typically comes all the way back, and the strangle would end up as a full winner or a very, very small loser. So that's why I like to wait for the stock to breach my strikes by a pretty significant amount before I actually do anything. Okay, welcome back. I hope you enjoyed that clip. And so now we're just going to go over my current positions that I have on to give you some updates as to where everything is at. I'm not going to put on any new positions today because I'm pretty much fully allocated. I currently have on 8 total different positions, and I certainly could have more positions on, but given where the VIX is right now, and I'll show you that in a second, but with volatility still being pretty low across the entire market, that's why I'm not going to completely allocate my portfolio right now. So starting off first with my naked put positions, I have 2. The first of which is an STX, which is Seagate Technology, and this one is definitely going pretty well. Let's go to the charts real quick. Now I have shown this one in a few of my other previous live option trading videos. So this was the stock where I sold a put option right here once the stock hit this support level that you can see in red. And so as I expected, we got a pretty nice little bounce here, which is very oftentimes what you see once a stock does hit a pretty major support level. And so also with the stock being up about $1.40 today, that's about 1.6%, I believe I'm actually very close to hitting my profit target on this position. So overall, I'm up about 190 bucks, and I do think if I find my closing order down here, there we go. So the current trading price of that naked put option is $228. I want to buy it back once it hits $210. So just 18 more bucks, and then I will close this position for a nice profit. Now what about TAL? If you've seen my other live option trading videos, you know this one has been a thorn in my side for pretty much every single day for the past month and a half or so. And you can obviously tell by the P&L open on this position, overall in this entire position, I'm down by about 1,500 bucks. And of course, that's because if we come to the charts real quick and go to TAL, I sold my 2 put options right around here when the stock was around 40 bucks per share. And since then, the stock has done nothing but just go straight down. Now, the good thing though is my hedge on this position has totally worked. Specifically, if I come back to the monitor tab and we go to the TAL tab here, you can see I'm also short 150 shares of stock. And from these short shares, I've made over $900. So that definitely has offset the losses on those 2 naked put options quite a bit. You can see here, the losses on just the put options is $2,500. So of this $2,500 that I've lost on the put options, I've made back $900 on the short stock and also over $100 on the 2 naked call options I also sold as an adjustment. Right, so originally I was just short 2 contracts of the 35 strike put option, but after a while I also sold 2 naked call options at the 37.5 strike, and because the stock has just gone even lower, that's why my naked calls are looking pretty good right now. So overall, my hedge has saved me over $1,000 of losses. And I can't stress how important it is to have these kinds of mechanics in your strategy. When things go wrong, especially in a worst case scenario, which TAL definitely is a worst case scenario, the stock has literally dropped almost 60 or 70% since I sold these put options, you must have a concrete game plan in place to adjust or hedge your losing positions, so that at the very least, you can turn your big losses into smaller losses. Because this is how on average, as you keep making trades, how on average you will turn the tide in your favor. Because if you look at the research that I've done in my previous videos, or you can look at the research that Tasty Trade has put out as well, just selling options in general, selling puts, selling strangles, whatever, and also doing nothing, that can be a profitable strategy. But like I said, if you can also combine mechanics that allow you to adjust your losing positions to mitigate losses, that will only serve to turn the probabilities more in your favor, so you can become even more profitable. So there we go, that's TAL, and I do believe I only have about 1 week left to go in this position, 7 more days until both these contracts expire, thank God. I just want to squeeze out every last cent of extrinsic value from these contracts that I can, and then just totally move on. I'll probably never trade this stock again. So let's come back now, and that's my naked put options. For my put credit spread I have on in XBI, currently this is down by a small amount of money, about 90 bucks or so. And that's because I sold this put credit spread right around here. My assumption here was that this trend line, which I'll draw back in really quick. Let's go to drawing tools and then trend line. Actually, there we go, it just popped up. So my assumption was that this trend line was going to continue to hold like it's been doing for the past couple months. But as you can see, boom, this ETF did cut right through it. Now, it's not a big deal. My assumption on this ETF is still unchanged. I am bullish on this stock for the long term and also the short term. So perhaps over the coming days and weeks, this ETF will continue to recover and just move higher. This put credit spread is in the August expiration cycle, I believe. Yep, there we go. So I've got 42 days before these options expire. That's a lot of time. And all I need is for this ETF to be above 135 bucks per share, which is only about $3 higher than where it is right now. So like I said, not a big deal. Let's come back. And finally, we have all my strangles that I have on. I believe there's 5 of them. So first up, we have EWZ, which is the position I put on this week. Let's check that out, EWZ. And there we go. As I expected, this ETF is continuing to kind of move lower. Now at this point, I do expect to see some sort of a bounce, maybe for a few days or 1 or 2 weeks. But overall, my assumption here is still that EWZ will continue to maneuver its way on lower down to this supporting trend line. And then perhaps at that point, it might bounce and resume back up even higher. And alongside this, we are seeing a pretty nice contraction in implied volatility. So I sold this strangle right around here when the IV was up to around 41%, and now it's back down to 30%. Very nice. So I would expect this is the main reason as to why my position on EWZ is currently up by about 25 bucks. Pretty cool. Now what about Space or Virgin Galactic? As you can see, I'm currently down by just over 100 bucks on this position, and it is just because of implied volatility expansion. Right, my strikes on this position, if I go back to the July expiration cycle, scroll down a little bit here, I'm short the 42 strike put option and the 75 strike call option. So right now the stock is pretty much right in between my strikes. My options are nowhere close to being in the money, and yet I'm still down by 100 bucks in this position with only 1 week left to go. And like I said, that is only because implied volatility has continued to expand so much. Right, I sold that strangle right around here when the IV was about 140%, and now it's at 180. And I'm pretty sure this is because Virgin has a very important launch this Sunday. I believe their CEO and a few other crew members are going to be participating in the launch. So of course, there's a lot of fear or uncertainty around this event. So that's why, at least for the time being, implied volatility is so high on Virgin right now. So hopefully, if the launch goes well, or at least if nothing bad happens, then come next week, you should see implied volatility get crushed. That's at least my expectation. And if and when that happens, I should see very quickly, because again, those options expire in just a week, I should see this position totally turn around very, very quickly. And next up, we have Bed Bath & Beyond, or BBBY. This position was an earnings play I made a little while ago, and so far it's doing pretty well, but I have not quite yet hit my profit target on this position. So if I zoom in here a little bit, you can see once those earnings came out on June 30th, I believe, we had a pretty big spike from 30 bucks per share all the way to 40 bucks per share in just one day. Not sure why. And then we had 1, 2, 3, 4 down days in a row, actually 5. And perhaps now we're finally getting a bit of a bounce here. So this down move is actually what caused my position to lose a little bit of money. This was a bullish skewed strangle here. So if I come to the trade tab real quick and go into the August expiration cycle, you can see the delta on my put option is 32. The delta on my call option is only 9. So this is still a very bullish skewed strangle. So with the stock moving down 5 days in a row, I was losing money on those couple of days. But also, with implied volatility contracting so much after those earnings announcements came out, that did help offset a lot of those directional losses. So overall, that's why I'm still up on this position by 150 bucks. So again, just more proof that implied volatility, if you can use it to your advantage in options trading, can really, really help you. When you're selling options, you always want to sell when implied volatility is high. And if you want to buy options, and I don't recommend you do, but if you do, you want to buy them when implied volatility is very, very low. Next, we have Clean Energy, which is a very similar story to my Bed Bath & Beyond position because, let's go to the CLNE charts. This was also a bullish skewed strangle that I sold on this stock, which is not going too well because the stock is moving directionally against me. It has sold off pretty significantly over the past couple weeks. And so right now the stock is at just under $9 per share, and I am short the 11 strike put options. So my put is a full $2 in the money, but because I collected around 200 bucks in credit for each strangle I sold, that means my break-even point is right around $9 per share. So even with my put option here being pretty well in the money right now, if the stock just kind of hangs around this price for the next 7 days until these options expire, I will basically just break even on this position. Not a big deal. But of course, there is still a week left to go, and I do hope that this stock does stage a bit of a bounce in the very short term. As you can see here, the stock did get down to and touch the 200 period moving average. That's what this yellow line is right here. And in the past, when I got back to this point back in May, you can see it just kind of bounced around that price point for a couple days and then boom, zipped right higher. So if this stock can do that again right here, that would be totally awesome. Let's come back. And then finally, I have my MU strangle, which is also just underwater by a very small amount of money. And again, very similar story. This is also a bullish skewed strangle and was also an earnings play as well. So the earnings came out right here on June 30th again, it looks like. And the stock did continue to fall lower. So right now my put option here is a little bit in the money. Let's go back to the August expiration cycle. There we go. So my put option is at the 80 strike, and right now the stock is at 78 bucks per share. So just a little bit in the money as of right now, not a big deal. No need to adjust or do anything at the moment because I am still bullish on this stock for the short term. I think this basing pattern you're seeing right here is going to continue to play out, and over the coming days and weeks, this stock will continue to work its way back up higher. But of course, one more example that a contraction in implied volatility, especially after an earnings announcement, can really save your butt in terms of mitigating the losses when you are directionally incorrect, right? Because this stock was all the way up to around 84 bucks per share before the earnings came out, and now it's dropped all the way down and hit a low of around 76 bucks per share. And even at this point, once my put option was pretty well in the money, I was only ever down by around 100 bucks on this position. And so there we go. That's the update on my portfolio. Pretty much every position with the exception of TAL is looking pretty good. I have not had to make any adjustments on anything else. It's only TAL that's causing the problems here. And like I showed you, this position will be gone come next Friday. So thank goodness. Now finally, like I said, I will not be putting on new positions today. That's because if we go to the VIX charts really quick, and again, the VIX will show you the implied volatility for the S&P 500, which is basically the bulk of the whole market. The VIX is now back down to a pretty low number, around 18. So at this point, with this level of volatility across the board, I am pretty much allocated to the max in my portfolio. 8 positions is more than enough for right now, but if the VIX does spike again, and perhaps goes much higher, maybe to 23 or 24, then at that point, I would not mind putting on even more positions, 9, 10, 11, maybe 12 at the absolute max. So this is another concept that you want to familiarize yourself with if you are selling options. You want to scale the amount of risk you have on in your portfolio with volatility in the market. The greater the volatility, the more positions you should have on, because the more you want to take advantage of that higher implied volatility. Options will be a lot more expensive during that time. And then the lower the VIX goes, the fewer positions or the less risk you want to have on in your portfolio. And so with all that being said, that's going to do for this video. I hope you enjoyed it. And please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.